It's always a great pleasure to have Sonali Basak from Bloomberg here on our stage. If you're not reading her already, I encourage you to. Sonali, let me turn the floor over to you.
This is Brennan Hofstetter of Generational Capital Markets, Harvey Fine of Marist Global Capital, and Cesar Anquillare, who's the Chief Executive Officer of Winchester Capital, which was formed by the Harriman family office of Brown Brother Harriman. We're supposed to talk to you today about the fourth industrial revolution. And so I figured the best place to really start is if we really think we're even in one. I'll leave that to my panelists to discuss, but do we really have the technological change today that matches the first, second, and third industrial revolution, which really kick-started new economies? Is that anything that you're seeing in the market right now, Brennan?
Sure. So Generational is representing hundreds of privately held clients in the merger and acquisition advisory space, and they're in the mid-market. And I would estimate that 80% of our client companies in the last 3 years have made investments in IT and software and cybersecurity, things of that nature in the million-plus range and quite a bit higher. And so for those companies, very much so. You know, it's become transformative. I would say a portion of our client companies have not made that type of investment, and they're either getting left behind in the marketplace or more difficult to generate buyer interest, certainly more difficult to get through a due diligence process. And for many of those, I think, frankly, they may be relying on the buyer to be able to align with a larger company and able to address those needs.
Harvey, are you seeing people make the technological investment that they really need to kickstart growth, and where?
Yeah, I think you pose an interesting question, and I do think it is, from a value creation perspective, similar to the previous revolutions, but maybe even more so from labor perspective, from a geographical migration, from business model perspective. I'm not sure if the technology yet is that innovative, but the disruption is pretty innovative, and I'll give you a couple examples of that. So I'm doing something similar to what I was doing at Fosun, right? Investing in primarily cash flow producing niche market leaders that we think can grow in China. But because the multifamily office that I work for, they're very tech oriented, so they also want to kind of promote a digital value add. And we're seeing a lot of companies wanting to tap into that value add from China. Because in China, I think the tech revolution, whether it's, maybe I should say it's the digital revolution more than the technology revolution, far exceeds what it is here. I mean, there's over 600 million mobile internet users there, which is twice the total population of the US. So people want to tap into that, and they don't know how to do it. So it is a industrial revolution or new revolution, but I think the way it manifests itself is going to be different than what we've seen in the past, both from a geographic perspective and from the type of companies that are going to be disrupted. In the Industrial Revolution, certain companies that were, Fortune 100 companies fell off the wayside and were replaced by other ones. I think we're starting to see that now too. But it's going to be more global in nature, and I think the labor markets are going to have to adapt in a very different way, because it's no longer just labor migration within the U.S., but it's labor migration globally.
And are you finding the same thing that Brennan was saying, that if companies in the U.S. have not made the necessary changes that they've needed to make, are they kind of lost in the M&A market, or are Chinese companies willing to invest in them as well?
I think I see a little of both, right? They certainly are suffering from a valuation perspective, but they're also likely to get gobbled up because there is, in China, a big thing that they talk about in the digital world is O to O, online to offline. So you have these very, very strong online companies that have valuations that are far superior to most private companies in China, but they don't have the bricks and mortars, they don't have some of the brands that they're looking for. So they're willing to acquire those, and the ones they're looking to acquire are probably ones that haven't had that technological innovation, so they can acquire them at better valuations and then translate that technology, the know-how into their and distribution into their ecosystem, so they can match their customers with the brick and mortar or with the brands that they don't have themselves.
So if you don't have fantastic technology, you have to have a wonderful brand or great real estate?
That's right. That's right.
Cesar, what about you? I know you see a lot of inbound deals from the UK, you were saying, correct?
Yes.
So what are companies and investors looking for from there?
I mean, at Winchester, 100% of our work is cross-border because we're a specialized boutique. And I think the most interesting response to your question, are we in the fourth industrial revolution, is yes, we are, maybe even the fifth. But it also, as opposed to just cross-border, is cross-industry. So for example, on IT and fintech, we received a mandate from a European insurance company. Why are they interested in IT and fintech? Because long-term, the prognosis is that technology will make more money and new insurance policies will be written because of the advent of sensors and other technologies. There's much more predictive maintenance. So therefore, the long-term effect is that the costs of policies, because of technology, may in fact go down. So profits have to be derived elsewhere. And I think this is a fascinating part of our evolving state of technology, that traditional industries like insurance, that we've all banked upon, 20 years from now, may be a completely different state of play because technology will transform them.
Are people kind of kissing a lot of frogs, right? I mean,
Sorry?
Are people kissing a lot of frogs here, I'm wondering? Because you're seeing, especially in insurance technology and fintech, there's millions of dollars consistently pouring into the market. And I'm wondering, are people making the right investments? Are they finding that it's better to build things in-house themselves? How much are they really spending on new technology, and how much of it is actually working, are you finding from clients?
I think, do you want me to answer that?
Yeah.
Or sure. I think that there are many frogs, but very few princes. And the situation with many companies is that they will only buy fintech or IT, I'm sure this is your experience as well, if they don't have it in-house and it's not part of their current R&D area. Larger companies also do not want to have an adverse impact on retained earnings. So what they try to do is economize by buying technology which is in a proof of principle or significant development stage. And by sort of buying it in its proof of concept, they gain greater economies than it would have cost them out of their R&D budgets to do it from the start. What I actually see happening, and we've seen it in many deals, is there's going to be a rise in strategic joint ventures where in the past, accounting principles, people have always been very concerned about buying 20 or 30%, as you guys know as well, because with GAAP, people don't want to consolidate losses, particularly with emerging companies that are R&D companies. So there's going to be many more strategic joint ventures where you have valid technology transfer, but there's a tremendous advantage to the larger corporate strategic partner by, in essence, not classifying it as venture capital. It's development capital, which gets their product or their service quicker to market.
Harvey, how about from your perspective, are people overspending on technology, do you feel like, at the moment?
I think they could be. I think one of the challenges that I see in the marketplace, and this includes my own investments, is in the past when you look at people acquiring technologies, they had business development or corporate development staff that were engineering or IT background, right? So Cisco would have a team that they would evaluate the technology and know how to integrate it. I think the challenge is because technology covers all industries, that these corporate acquirers are trying to make these same acquisitions, but the people that are doing it for them don't have an understanding of the technology. And even if they do, there's been no precedent as to how that technology is going to impact their own business. As an example, Walmart buying Jet.com may be a very smart acquisition, but I'm sure the people that led it didn't have the kind of expertise to gauge whether or not it would work. And I think you're seeing more and more of that as people who are worried about getting disrupted offline are trying to buy into technology that can resolve that, and they're not really sure if it can work. So that probably lends itself to overpaying. But I'm maybe in the same boat too. I don't know if those technologies are going to work. So maybe I'm also in that same boat that could potentially overpay. But you sort of need it, because if you don't have it, it's almost better to do something than nothing at all.
I have a follow-on for them. Both Caesar and Harvey mentioned something that's very interesting that they're seeing because of the IT revolution, which includes a broad range of things. They're seeing more cross-industry acquisition. And I'll just give you a quick case study of a transaction that myself and my VP Julio closed last year that was very interesting. They're in the media space with heavy technology emphasis. And the strategic buyer looked at the business and realized that in their cost structure, there was $4 million of expenses that this company was spending on media and IT and software and different services that the buyer itself provided through one of their own subsidiary companies. So there was a strategic advantage for that buyer versus others to acquire this company and immediately create $4 million of purchases going out to another competitor into the buyer in-house. We estimated at about a third margin contribution. And so I think when we at Generational think about the expenses of our client and more of it becoming IT related and software and technology based, we're going through the P&L, understanding where those spends are, and could that open up buyer opportunities in that way.
Brennan, I'm also wondering from your experience also, what are some of, you talked about Walmart, and we're hearing a lot about insurance and auto and a lot of old line industries, looking for growth in tech. I'm wondering kind of where you see the most interesting opportunities for disruption and technological change and acquisition. What are some of the more interesting industries that are looking?
Well, we've certainly seen an increase. I would answer that question this way. We're a high volume firm, and so we touch on virtually every industry. And what I've noticed in the last 10 years is that more and more of our clients either are or are moving towards a recurring revenue type model, whether it's providing their service with a recurring revenue. And I know that's not exactly technology, but it's what software has done forever, right? Having relationships versus transactions and being able to charge monthly and annual subscriptions and licenses. And we're seeing more and more clients moving that way. And we're seeing the buyer interest for those deals certainly increasing, as is the multiples that they'll pay.
What's an example of that in an old line industry?
Well, we've had a few commercial service businesses. For example, I had a client providing industrial maintenance into pulp and paper, which is just an old line of business, right? Very labor intensive, but many of those maintenance contracts are milk run type, so they're putting them on long-term contracts where they can better gauge the utilization of manpower and tools and equipment, and they're locking in these contracts, providing good pricing to clients, but long-term manageability for my client company. That's just one example.
I think something interesting you brought up too is your buzzword was recurring revenue, and I'm wondering when you guys talk to clients, what are the buzzwords? What's the biggest one? Is it blockchain? Is it IoT? Is it cybersecurity? I mean, what are the biggest topics? And maybe Caesar, you can guide us with this. What are they talking about that's on the cutting edge that they want to embrace?
I think recurring revenue is important, but technology and innovation can be the enemy of recurring revenue, because you wake up one morning and somebody has invented the better mousetrap, the more capable piece of technology, which suddenly overtakes you in the marketplace. And then the question is, what's the response? So I think there is far greater emphasis now than ever before in companies that are innovative to be constantly innovative, to not be where they are, but to envision where they should be. And the elements of competition, particularly in fintech and IT, have never been greater.
That's true.
Maybe, yeah.
Chanel, you asked about which industries that we're seeing, or the ones that we're looking at. Two of them are healthcare and retail. And I'll give you an example of a healthcare company that we're looking at, which is, in the old days, it would have been done one way, and now it's being done differently. So they have three different types of hardware. One is to make imaging, ultrasound imaging, a lot cheaper. The other is EKG patches, a little simpler, and things like that. And the third is a diagnostic kit that does liquids, blood, saliva, urine samples. So those in and of themselves would be successful businesses, but they choose to give this away almost for free because they're collecting the data, and they're actually, as you mentioned, recurring revenue. It's a software as a service model where they're doing the diagnostic and analytics to provide to the medical professionals what that is, because they realize that my margins on this are so much bigger. So even though they have pretty innovative hardware, they've chosen to focus on the software side because it's much more scalable for growth. And that technology includes machine learning, AI, all this stuff to become more and more advanced as they collect more data. On the retail side, we're seeing the same thing. I'm looking at a company that has a very strong offline brand, but it has very little digital presence, even though there's a good following. So their hope is to attract an investor that can help them, move into that world where it's much more scalable. So they don't need to have the physical shops, but they use their content as a way to sell their products. And again, it's not new technology per se, but it's a new business model that's driven because technology is available to push that content out directly to their customers and to deliver products that are relatively customized to individual customers.
I want to flip the question on its head for you also, just because right before we came in to the panel, we were talking about how some of the best technology companies are able to succeed and grow and gain investor interest by old playbooks. And I'm wondering if you can use that example of how you've seen it work for Airbnb or WeWork, who have been able to succeed using very traditional kind of growth strategies.
Yeah, you mentioned that, because WeWork, when we looked at it as a potential investment, it was already pretty highly valued. And if you look at it on paper, they're not that different than the old Regus model, right? They have a bunch of real estate that they lease, and they lease it out to sublease it out to other people at higher rates. Kind of interesting business model. But where they justify their really high valuation is through their technology or secret sauce, that they gather all this data about how successful businesses operate, how their workplace is configured, traffic flow of their employees and things like that, and they go to large corporations who maybe will not be subleasing from them to say, we have this technology, this insight that we can provide to you. And it's almost like a hotel. Instead of like Four Seasons, when they first started out, they owned their own real estate, and they morphed into a management company with the Four Seasons brand, and say every Four Seasons is going to look a certain way and feel a certain way. And WeWork is trying to do the same thing, where they say, well, for ABC company, where it's GE or Goldman Sachs, we can manage a certain space for you and give you the best of breed of what we found from all of our companies globally. And that gives them a scalability and the sort of the tech cachet that gives them this very, very high valuation that's hard to justify from its metrics alone.
As we were talking about kind of the whole time so far, really, is, all of these investments don't come cheaply. And I'm wondering, given that all three of you have such different backgrounds with family offices and with private equity firms, and, we were talking a bit about foreign investment as well, where is the investment of tomorrow coming from? I mean, where is it from family offices mostly? Are we going to see more private equity firms behave a little more like technology firms, right? Or venture capitalists? Who is most willing to invest in the companies that seem to have high growth, technology type growth potential? Caesar, do you want to get us started on that?
Yeah, I think that we're in one of the most buoyant economic periods in history. If you saw the Financial Times this morning, they say that volatility has never been this good since the 1960s. So there is, without a doubt, at this point, a very high degree of liquidity, both in unspent dry powder from private equity funds and also corporations that have made good profit that are considering reinvestment modes. So I would say that now is the moment, and hopefully will be the moment for the next couple of years, for sourcing that investment. I think the other area that's quite interesting, Harvey and Brendan alluded to, is on disruption of technologies. Because there's existing investment that's gone in technologies that can be transformational. In a case study, years ago, we made an investment in a company called Vibrometrics, which made sensors. And the Harriman family have always been very patriotic. These were sensors that were put in the skin of our submarines, and British submarines, to ensure that we could hear the Russians a long time underwater before they could ever hear us. That same technology was used in pediatrics, because when cardiology takes place and they have to operate on an infant's heart, they need to be able to monitor blood flow. So the same super sensitive sensors were used with children, and eventually a Japanese firm, Fukuda Denshi, bought the technology for use in monitors. In that case, it wasn't investment that was required. It was just a new application of the existing technology that saved military lives and then children's lives.
Wow, very cool.
Brennan, do you want to talk about where you're seeing a little most of the investment coming from among?
Well, so Generational, we represent sellers. We give a very exhaustive approach, so it's going to be deal specific. But I would make maybe a last comment on another trend we're seeing relating to technology. We're talking about this in the context of M&A transactions. And in order to get an M&A transaction done, you have to get through a due diligence. And 15 years ago, the four cornerstones were operations and financial and legal and environmental, with many subtopics underneath each. But nowadays, IT is the fifth cornerstone that we see, where buyers are taking very deep dives into the company's IT, especially if it's a software firm, where they're hiring outside experts to perform code audits, make sure that our clients actually own all the IP, make sure that they've got client sign-off, they've got sign-offs from past and current employees, subcontractors and contractors that have worked on the technologies. That can trip up a lot of small private businesses that have been fighting so hard to stay up with competition and haven't really documented their system and their IP as well as they should. Have they had lawsuits? Have there been patent trolls active in their space? All of these questions we didn't deal with 10 and 15 years ago are now front and center with buyer due diligence on virtually every kind of company, but especially if they're software and technology related.
Just one more question also on, what kinds of buyers are out there in the world. Caesar had mentioned too that there's so much dry powder, right? I mean, we're in a record fundraising year right now. Is the fact that there is so much private equity capital out there, what does that mean for strategics, and what does it mean for corporate purchase volumes in technology businesses? Harvey, do you want to get started?
Sure. I do think there's a change in where capital is coming from. As you said, it's going to become more global because businesses are more global. I think there's also a concentration of wealth in several areas. One is in private equity. So the large private equity players are now raising 10, 15, $20 billion funds. So there's more getting sucked up to them. Family offices are becoming multi-family offices because there's economies of scale for that. And you have people like the SoftBank Vision Fund, which is just, even outsized sizes. Because of that, I think they have to chase yield, so they're going to play across the investment spectrum. You have TPG investing in Uber, and even though it's more of a venture investment when they made it, but they're doing private equity size investments in those sectors. I mean, even for me, when I was at Fosun, we invested in Alibaba in a pre-IPO round, but at that time it was already generating several $100 million of cash flow. So it was really a private equity opportunity, but the people that we sat with in the capital structure were everything from family offices to venture capital, because everyone was chasing those good deals. It didn't quite fit their mandate because it was a private equity opportunity. It didn't quite fit our mandate because it was a venture opportunity, but you did it because you knew that was going to be the next big success. So I think people are going to be less pigeonholed into their silos and more to deploying capital in areas that are disruptive, because technology is becoming so disruptive across all channels.
With that said, also, I'm wondering if this means that, I cover boutique banks actually at Bloomberg, and we hear a lot of commentary about how people have been very hesitant to buy things in public markets with valuations being as high as they are. Wondering if this is a concern you have. You guys painted a pretty bright picture about the economy so far. So wondering, how long is this going to last for? And, are people going to keep on waiting as the market just keeps on grinding higher? I'm going to get started on that, Caesar.
Make hay while the sun shines. I don't think by any means the buoyancy in the markets that we're experiencing is fleeting. 2018 is now forecast to be one of the best IPO years in a long time. The pipelines are extremely strong in London and New York. I do think that one has to be much more adaptable to change. And to get back to your earlier question on private equity versus strategics, well, the change that we're seeing in the M&A marketplace now is that in years past, you would never think of contacting a private equity group if there was a solid fit with a strategic target, because synergies would always give you greater valuation for the strategic. That's now been overtaken by a new generation in private equity groups, because some of the traditional funds that were 10-year limited partnerships are much more evergreen, especially the ones with family office money in nature. So therefore, they can pay a competitive value for the same asset because their holding period is longer. And you may well find that the return on investment cycle inside some of the strategics is actually shorter than the longer-term private equity thinkers that may be able to take lower return for a longer period of time but higher growth.
One of my favorite questions also is, given there's so much private equity capital, and even beyond that, so much family office capital, and then, sovereign wealth money now also kind of playing in the private equity pool. Do you think with all of that private capital that there needs to be a stock market in 50 years? Do you think that, private is, and that, I know that's very theoretical, but do you think that private is the way to go? Are people finding more ways to stay private?
It's a great question. I'm a little biased because my entire career has been in the private markets, but I do think there's always going to be some market for public securities, and partly because it allows you to aggregate so much money so quickly versus more concentrated bets. And there are going to be companies that prefer to have a diverse group of investors as opposed to a few concentrated ones, which is the way that the private investors are going to go. I do think it could delay the time for people to go public, but keep in mind that because of the tech boom, that time to IPO has been compressed maybe artificially to begin with. So maybe it'll reset back to where it should be, where companies are going public when they're really ready for being public. And the second thing is, maybe the public markets will be different than we envisioned it, whether it's Bitcoin or more direct as opposed to through the traditional exchanges. I think maybe that's more likely, but I do believe there's going to be some market for both public and private, even in 50 years in the future.
Brendan, are you finding clients want to stay private more often?
The hurdle to go public because of Sarbanes-Oxley and just the costs have caused it in my career to where companies that are considering sale or potentially go public really don't have that choice now to do it cost effectively. And so I too am biased working in the private side. I think there'll always be public marketplaces, but the hurdles to achieve that are just so much different and higher than they were in the past.
Caesar, are you finding that your clients are saying similar things?
Yeah, I think that many of our clients are much more long-term in vision. For example, we just recently did a study of the different capital markets. And if you take the London stock market, the LSE, the New York market, the Amex, and you combine all the UK American ones, you'll find that the gross market capitalization is still about 3 times the size of the Chinese markets, but that the growth in the Chinese markets is coming up much more quickly. The reason for that also in part is that one has to differentiate value realization from capital raising. What's great about going public, particularly if it's in the minor markets, is that people know there's a standard of accountancy and compliance, so that if they're investing on a real growth shot, that at least there's compliance to a minimum standard, even in foreign and emerging capital markets, to be able to make a bet. I think that private companies are still disadvantaged because they will tell you that they have the greatest invention since sliced bread. They will go out and say, well, look, this, and I'm sure you've experienced it, this particular technology is worth 500 million. Oh, and by the way, we haven't made a sale yet. It's still much more frothy with risk, whereas at least the future of capital markets, I think, is very secure. But what I think we will find is that the capital raise aspect, SPACs, for example, have been very much up in popularity. Right? The capital raising aspect will become increasingly important over the next few years.
I had asked earlier, but I'd really like to get some more specifics too about when it comes to technology, what that means to your clients. Right before us, we had a panel on Bitcoin and blockchain, correct? So I'm wondering, is this something your clients think about, and in what capacity? And I know they're two very different things, right? One is the currency versus the underlying technologies, but what are they talking about?
Yeah, honestly, just speaking for generational clients, Bitcoin and blockchain may come up in conversation with a few, but taxes are much more on the mind of small private business owners. And while M&A is at peak periods, we're targeting 100 closed transactions this year, which will be a record. We hope next year is the same or higher. But right now, we've got some clients that have pushed the pause button, not because they're concerned that tax rates will get cut deeply, they're just uncertain. And especially transactions that have a high component of the assets made up in the valuation of the business. To the extent that you transact an asset sale versus stock, that could mean significant savings if, in fact, tax changes were affected. So right now, at this moment in time, there are a few transactions that are on hold waiting for the outcome of that.
So people are thinking about Washington more than Silicon Valley still.
Our clients are.
I think in the U.S., cautious optimism reigns. However, and also obviously in Britain because of Brexit. What's been really interesting is the number of internal transactions investing in fintech and innovative technologies within Britain itself. I mean, we are now 3 times the valuation inside the UK. 60 billion will be done in deals this year versus 23 billion in the UK internally last year. From a global perspective, 3.2 trillion is the deal number, dollars, for 2018, which is now forecast. And if you talk to the pessimists 2 years ago, who were taking telephone calls from their windowsills, they would have told you in a post-Trump era that volume would be going down, but it's not. It's going up.
How about you, Harvey? What's the number one thing people are talking about, if not Bitcoin?
On the technology side, because we're a private equity investor, we're not as focused on investing in technology itself, but how technology can benefit more traditional companies. So a lot of it is around machine learning. How can we serve our customers better or get to our target consumers more accurately and more cost effectively through these sort of algorithms? And again, it's funny how it goes across multiple industries, but it's the same thing. How do we sell better to our customers? How do we do it more cheaply?
Guys, well, time is up. I want to say thank you to our panelists who made the last hour go by so quickly. It was nice meeting you all too, and I'm happy to say hello after as well. And thank you guys for taking time with us today.